Sawadika, hello and a very good afternoon to all. Welcome everybody of you to the webinar on responsible investment in practice, implementing ESG incorporation in listed equity and fixed income. My name is Pami Sinida Petvilakun, truly honored to be here today. And today's seminar will be hosted as an online format with the intention to enhance the capabilities of capital market participation on the facet of ESG integration and application of principle of responsible investment that was developed by the PRI and is supported by the United Nations. So as a background, the PRI works to understand the investment implications of environmental, social, and governance or ESG factors and support its international network of investor signatories in incorporating these factors into the investment and ownership decision. Therefore, in supporting the Thai investors and market participants in the incorporation of ESG factors into the investment process, the first session of today's agenda will begin with a presentation on ESG integration in equity asset, which we're honored to have Mr. Michael Bartek, Senior Lead, Listed Equity Investment Practices, PRI, for the presentation, and followed by a presentation on ESG integration in fixed income, for which we're also honored to have Ms. Carmen Nuzo, Head of Fixed Income Investment Practices, PRI, for the presentation. And next, for the second session, the PRI signatory will share a case study for applying ESG integration in equity asset. And this will be presented by Mr. William Ng, Senior ESG Engagement Analyst at Hsbc Asset Management. And this will be followed by a case study for applying ESG integration in fixed income, which will be presented by Mr. Eric Neach, Head of ESG Asia Manulife Investment Management. And then the final part of this webinar will be a panel discussion followed by Q&A, where we'll provide an opportunity for the participants to feed in the questions. So these are the agendas of what you can expect through today's program. On this occasion, I would like to invite Ms. Runwati Suwanmongkol, Secretary General, Securities and Exchange Commission, Thailand, to deliver the opening remarks.
Sawadika and a very good afternoon. Ms. Gita Sabrawal, the United Nations Resident Coordinator in Thailand, Mr. James Robertson, Head of Asia, PRI, distinguished speakers, ladies and gentlemen. It is my pleasure to welcome you all to the webinar on responsible investment in practice, implementing ESG incorporation in listed equity and fixed income under the flagship of Responsible Investment Series, where the first one was held in last December to introduce the principles for the responsible investment, or in short PRI, to the Thai market participants. I am very pleased to give the opening remark this afternoon. Given the SEC continued emphasis on fostering a more sustainable and responsible capital market ecosystem, it is therefore encouraging to note the industry's ongoing commitment and participation based on the substantial interest and turnout for today's webinar. Ladies and gentlemen, as an investor, issuer, international body, or regulator, we all have a role in building a sustainable capital market ecosystem, which would help the country progress toward achieving the United Nations Sustainable Development Goals, SDG. At the SEC, our focus is on capital markets, raising awareness and protecting investors, maintaining fair, orderly, and efficient markets, and promoting capital formation as well as an ecosystem for a sustainable capital market, which would help in accelerating the sustainable economic growth needed to broaden prosperity of the nation. To fulfill our mission, we must work hand in hand with our colleagues all across governmental and international bodies such as the UN and PRI, and market participants, including those of you present today. In fact, one of the very important roles that SEC serves is to ensure that decision useful information gets into the market in a timely manner by, among other things, setting public company disclosure standard. As you probably know, from this year onwards, the SEC requires all listed companies to integrate their sustainability information into their business reporting via the new disclosure form called 50-1 report, which includes carbon emission information and human rights issues according to the UN Guiding Principle on Business and Human Rights, UNGP. On the supply side of the sustainable finance ecosystem, the SEC has developed a set of fundraising instruments such as green bond, social bond, sustainability bond, and sustainability-linked bond, with the total issuance value of $12.68 billion as of last month. As for the demand side, the SEC has introduced the disclosure standards for Sustainable and Responsible Investing Fund, SRI Fund, in April this year, which aims to promote consistent, comparable, and reliable disclosure of ESG-related information of mutual funds. With this, asset managers who manage SRI fund are required to disclose the sustainability objective of the fund and how such objectives are attained. Such disclosures would assist investor understanding and assessment of whether the targeted fund meet their investment needs and therefore reducing the potential of greenwashing. Against this backdrop, we observe that the asset management industry commitment towards sustainable investment continue to increase in recent years. As more capital is channeled toward economic activity and projects that are aligned with the UN SDG, furthermore, we also noted a healthy increase in the number of PRI signatories who have committed over $121 trillion of assets under management to investments that integrate ESG criteria. Clearly, both asset managers and asset owners can play a leadership role in driving sustainability, given the position of strength and stalwart of investment. This is by integrating sustainability as a primary factor in the capital allocation decision, including undertaking active engagement with investee companies in improving their sustainability practices. Action and decision by asset manager and asset owner can shape and influence the design behavior and instill greater urgency among the investee company to transition toward better sustainability practices. Indeed, the global sustainable investment industry is projected to grow to $160 trillion by 2036. The asset management industry in Thailand must ride on the wave of these trends and step up effort in offering a wider range of sustainable investment choices for investors. These include the introduction of more innovative sustainable funds, focusing on thematic ESG themes that resonate with investor interests and demands. In fact, today, investors increasingly want to understand the ESG risks, particularly climate risks, of mutual funds they invested in and intend to buy. In light of this, the SEC is in the process of introducing climate risk management guidelines as well as ESG risk integration guidelines for asset managers, which set out sound climate risk and ESG risk management and investment practices, including the disclosure of such information that asset managers can adopt. While there are opportunities, the SEC recognizes that the industry is also facing several challenges. For this reason, the SEC has introduced various initiatives, including organizing series of webinars such as this one to help in building capacity and develop a facilitative ecosystem for sustainable investment in Thailand. This would enable the capital market to be a part of the solution and to meet the sustainable development objectives. Ladies and gentlemen, I sincerely hope that today's webinar is forming a continuation of collective disclosure with industry to advance the development of responsible investment and sustainable agenda. Please allow me to take this opportunity to give my heartfelt appreciation to Ms. Geeta Sabrawal, the United Nations Resident Coordinator in Thailand, and Mr. James Robinson from PRI for their strong commitment to supporting Thailand and encouraging our market participants to integrate the sustainability issues into investment and ownership decisions, as well as to become PRI signatory. With that, I look forward to the webinar presentation and vibrant discussion ahead. Thank you very much and ขอบคุณค่ะ
Thank you very much, Ms. Brunbadi Suwanmongkol, Secretary General, Securities and Exchange Commission, Thailand, for honoring us with the opening notes and for your strong commitment in driving Thai capital market towards sustainable development. Next on the agenda, I would like to have the honor of Ms. Geeta Sabrawal, the United Nations President Coordinator, Thailand, to kindly welcome the participants.
Distinguished guests, colleagues, and friends, I'm honored to join you at this important seminar, which focuses on drawing out the best practices to integrate ESG in listed companies and mutual funds in Thailand. Let me thank the co-hosts for making this dialogue possible. My special thanks to Khun Ruwanwadi, the Secretary General of the Securities and Exchange Commission, for her leadership and foresight in supporting the establishment of a sustainable investment ecosystem for the private sector, banks, and investors to accelerate the green transition. Khun Ruwanwadi, your personal commitment to UN guiding principles on business and human rights has been crucial to progress the ESG agenda in country. Many of the listed companies, as you know, are institutionalizing the principles of human rights into their business operations. Under your leadership, the SEC has also launched the One Report to standardize sustainability reporting and enhance the quality of information disclosure of both issuers and listed companies on the Stock Exchange of Thailand. This is an important step which will contribute to developing consistent standards to green the economy. I would also like to thank James Robertson. As Asia head of the Principles for Responsible Investment, he serves a vital role with PRI providing a useful framework for achieving better long-term investment returns in more resilient markets. PRI also creates the impetus for fund managers to mobilize their energies towards incorporating ESG into investment and ownership decisions contributing to sustainability gains. As you know, capital markets have a huge influence on the Thai economy, and responsible investments premised on ESG are crucial to bottom lines in a world increasingly dominated by concerns over long-term sustainability. Importantly, the PRI agenda must be domestically owned in Thailand, and leadership on it has to come from within the country. By investing responsibly in line with the BCG and other policy frameworks, domestic champions of the investment world can lend invaluable support to these transformative sustainability agendas whose aim encompasses inclusivity, equity, and transparency. An important step in that direction was taken last year at the Sustainable Thailand Forum, co-hosted by the government and the UN, where 43 financial institutions with total assets of over $1.3 trillion committed to action on the SDGs and climate. ESG investment is continuing to mature in the country, with the pipeline of sustainability-related projects growing slowly. Dialogues such as today will help the agenda move forward. According to the finance markets, ESG lending has helped them weather the pandemic better, with net returns more sustainable and shareholders much more confident. There are champions in the finance sector with the Government Pensions Fund and a couple of major banks leading on sustainability. Each of you have a pivotal role in supporting the green transition, and your investments can support the fast tracking of introducing best available clean technologies, scaling up sustainable solutions to reduce emissions and create green jobs in the country and the region. As you know, your investments can leverage change at a much faster pace. Going forward, sustainable investment requires a multi-pronged approach to tackle global and domestic challenges. Climate change is posing unfamiliar risks, but frontlining sustainable investing will boost risk mitigation and resilience. Sustainable investment strategies need to go beyond excluding brown industries and in favor of new green technologies. They must also support companies in transitioning from brown to green in their operations. A practical green taxonomy, which is being developed by the Working Group of Sustainable Finance, led by the Bank of Thailand and the SEC, will help Thailand's financial markets better evaluate environmental performance and direct investments accordingly. Another critical building block lies in enabling greater transparency and clarity on issuer-level transition pathways. We need to identify, assess, and measure companies' decarbonization strategies. Having robust sustainability reporting standards is a good place to start. To that end, the SEC's One Report, which I mentioned earlier, provides guidance for businesses to operate responsibly on ESG dimensions with a focus on human rights, companies' sustainability strategies, environmental impacts, and social engagement. Simultaneously, continued upskilling in the financial industry will boost competencies and uphold values. Financial regulators need to develop technical know-how in green bond issuance and taxonomy, the impacts of climate risk in infrastructure investment, as well as responsible lending and investment. A sustainable finance certification or a baseline sustainable finance curriculum can also be considered for Thai bankers and investors. Our overarching goal must be to build a sustainable and inclusive economy that meets the goals of the Paris Agreement while leaving no one behind. Global impetus is building on climate action in Thailand, and Thailand is well placed to tap into it. At COP27 last year, some 450 financial institutions from across 45 countries with total assets worth $130 trillion pledged to achieve net zero carbon emissions by 2050. In Thailand, closer coordination between the regulators and the industry will be essential to achieve national sustainability objectives on schedule. UN Thailand looks forward to working with you all as the country continues on its ambitious green journey. By sharing your expertise and experience in today's discussions, you will all help generate creative ideas and lasting solutions for the future. I'm looking forward to a very fruitful outcome. Thank you and Khap Khun Khap.
Thank you, Ms. Kita Sabawal, the United Nations Resident Coordinator Thailand, for welcoming the participants and for the relentless support the UN has provided Thailand in working toward achieving the Sustainable Development Goals. Up next, we would like to invite Mr. James Robertson, Head of Asia, ex-China and Japan, PRI, to give a few words on this webinar, please.
Ladies and gentlemen, welcome and thank you for joining us for today's webinar on responsible investment in practice. On behalf of the PRI, I would like to express our sincere gratitude for the support and leadership shown by Kun Runvadi, Secretary General of Securities Exchange Commission, and Kun Gita, United Nations Resident Coordinator for Thailand, and applaud the efforts of their respective organizations in building awareness around the importance of environmental, social, and governance issues for both corporates and financial institutions. Including ESG factors in investment decision-making and ownership is no longer seen as a nice-to-have, but a must-do. Investors are increasingly seeking to enhance their performance through more insightful evaluation of long-term risk factors and by identifying new investment opportunities that take into account the rapidly evolving needs of their beneficiaries and clients. Alongside this, regulators are stepping up to provide the guidance and structure necessary for the transition to a more sustainable global financial system. And we've already heard examples in the welcome remarks of how this is being done by the SEC in Thailand. Capacity building sessions like today and the wider efforts of stakeholders like the UN, the SEC, and others are crucial in helping establish and grow a sustainable and responsible investment ecosystem in Thailand and demonstrate the great value that can be achieved through collaboration. In 2021, our first seminar for the Thai capital market focused on introducing key concepts and practices, such as the development of a responsible investment policy. Today, we are delighted to continue this partnership with a focus on implementing ESG incorporation and responsible investment strategies in listed equity and in fixed income. I would like to give thanks to today's speakers from Manulife Investment Management, Hsbc Asset Management, and of course from the PRI, to the team at SEC for their efforts in organizing today, and of course to all of you who are joining us online. I do hope you find value in this session. Thank you very much, and Kapanka.
Thank you very much, Mr. James Robertson, Head of Asia, ex-China and Japan, PRI, for your kind remark and the capacity building and all the support provided by the PRI to Thai market participants are very much appreciated. So before moving on to the first session, I would like to invite all dignitaries who have been welcoming the participants and all speakers to kindly turn on the camera for a group photo, please. So please kindly look collectively at the camera as I start counting. 1, 2, 3, and hold your position for a perfect capture. Thank you very much. Also, let's have another photo opportunity with the viewers online. Session, we shall begin with the first presentation on ESG integration in equity asset by Mr. Mikhail Bartek, Senior Lead Listed Equity Investment Practices from PRI. Allow me to give a reminder that if any of you have any question, please feel free to type in the questions through the chat box, or else you're welcome to ask the speaker at the end of this session as well. And also we have the simultaneous interpretation. You can click on the globe icon on the right-hand corner of your screen. Okay, now, Mr. Michael Bartek, the floor is yours.
Thank you very much for that. Good afternoon to you all. I'm Michael Bartek. I work in the investment practices team at PRI. My background is in equities. I spent about 15 years working as a sell-side research analyst, and subsequently I spent about 10 years working as a portfolio manager, managing regional and global long-only listed equity portfolios. So that's the bulk of my background. In addition to that, I spent about 4 years, actually 5 years, working at CFA Institute, developing the CFA curriculum. I'm not sure whether you can see my slides. I do have a number of them sort of to share with you. I will not be going through every single one, but I'll highlight the main ones and maybe make reference to some of the supplementary sort of support slides. So if we could go to the next slide, please. Here we have a bit of a reminder of our definition of responsible investment. So in our view, or according to our PRI definition, it's a strategy and practice to incorporate environmental, social, and governance factors in investment decisions and active ownership. Now, I'll focus most of what I'm going to say about the investment decisions, about the different ways of incorporating ESG factors and investment decisions. But I think it would be wrong to ignore the active ownership side, which is not really the focus of my presentation, but it's something that is crucial to sort of successful employment of ESG asset management strategies. So if we could go to the slide after next. So if you could go to slide 4, thank you very much. So here we have a bit of an overview of the approaches to responsible investment in listed equities. And I guess those of you familiar with this space will not see this, as surprising or sort of unclear in any way. I would say that most typical starting point among our signatories is the issue of ESG screening. ESG screening tends to be used as something that most asset managers sort of start with before moving on to the actual either integration or construction of quant techniques or perhaps passive strategies. I will not be focusing a great deal on the active quant approaches. I'm happy to answer questions about those. And I will not be devoting too much time to passive strategies. But what I would like to say is that ESG screening tends to be, I would say, the most traditional sort of starting point in sort of ESG investing. And I'll say a few more things about that. Now, ESG integration on the left-hand side is obviously done in many different ways by many different entities, but it is something that more and more of our hundreds and these days thousands of signatories have been introducing over the last sort of decade and a half. And I'll focus on what that implies, and also what major changes we've seen over the last few years when it comes to the use and implementation of ESG integration. Okay, let's move on to the next slide. So with regards to screening, as I said before, this is the typical starting point, and most common one is sort of exclusionary screening, which is driven by client preferences. Sometimes it is driven by wish to comply with regional or local regulatory requirements, and there are a number of sort of techniques and sort of decisions that need to be made before settling on a particular type of exclusionary or negative screening. The bottom line is that the result of exclusions is that it does reduce the investable universe, and inevitably it has subsequent implications on portfolio metrics such as tracking error or volatility on its own. The other types of sort of screening I see as are sort of foundations for subsequent analysis. So there are many signatories of ours who use screening as a way of sort of narrowing down the universe from which the asset managers then pick the investments that they prefer following further analysis. So this best-in-class or positive screening is used very sort of actively for the asset managers to be able to filter the investment universe and end up with a selection of potential investment opportunities that satisfy a particular criteria. And unless we're talking about sort of more mechanical, rules-based, say quant or passive approaches, most of the time this is used in the active fundamental space to guide the asset management teams into areas or types of companies that they should subject to further scrutiny through ESG integration. And norms-based screening basically overlaps with the sort of inclusionary screening element. It also reduces the investable universe, but it does not necessarily exclude any specific sector. Okay, so let me turn my attention to, I guess, the core of what I'm trying to say. Let's move to slide 8, which is sort of 3 slides further down. And here, just want to say a few sort of initial sort of starting messages regarding ESG integration. So first of all, what is it? Well, it is the systematic and explicit inclusion of ESG factors into investment analysis and investment decisions. It does mean that one obviously analyzes both the traditional financial as well as ESG specific information. It does involve identifying what are material issues, what are material ESG concerns or ESG factors, if you wish to put it that way. And that obviously serves to help with sort of forecasting or establishing a view on the future, the choice of valuation model, and the subsequent investment decision. What it does not mean is that one is prohibited from investing in particular companies or sectors. That may be what screening is used for, if that's what the client preferences are. But integration is not really about exclusions of anything specific. ESG is more about taking a more in-depth view and in-depth analysis of whatever the material factors are. And of course, it's got to be treated alongside the traditional financial factors, the traditional financial analysis, and it's something which I'm going to focus on the next slide. Now, when it comes to portfolio returns, I guess we could debate that for hours, maybe days, maybe weeks. And whilst we don't really have much room to go for that sort of debate, I would be happy to answer any questions you may have about that. Ultimately, I think it's widely understood that incorporating ESG factors into investment consideration, if anything, helps address some of the risks which otherwise one would face and fail to capture if one was to ignore what the relevant material ESG factors are. But let's look at all this in a bit more detail. So let's move to the next slide. And whilst different teams have different sort of approaches or even investment styles, ultimately we see the role of ESG in a number of sort of contexts. So when it comes to the fundamental analysis, by which we mean the broad analysis of sectors and how they fit into the wider economy, assessment of company fundamentals in the broader sector space, we should already be thinking about the relevant material ESG factors. Now, where do we find those? Well, as you know, there are a number of providers of ESG information, and we see that many investors rely on those service providers who provide ESG analysis and ESG ratings to figure out what the material factors are that impact a particular sector or individual companies. So that is a useful source of information, which I would say the majority of our signatories rely on. In addition to that, our signatories have a or many of them have a wealth of existing knowledge, in-house proprietary databases. So they are already familiar with the sort of social or relevant governance or environmental issues that are specifically relevant for their companies based on their knowledge, based on their past experience. And there are also publicly available materiality maps out there, such as the Hsbc materiality maps. Now, those relevant ESG factors should ideally be assessed and understood at this fundamental analysis stage. The reason I'm saying that is because what we have seen an evolution in this space over the last 10 years, whereas traditionally ESG factors were treated as a bit of an add-on to the analysis. So what used to happen is that the analyst or the portfolio manager, if he or she was carrying out the research, would carry out the standard traditional analysis of financial statements and the company characteristics, and they would then pick a selection of 2 or 3 crucial relevant ESG factors, and they would make adjustments to their future forecasts, or they would make adjustments to the valuation model. What we have seen with our most advanced signatories is that they no longer leave that ESG sort of decision or analysis element as the last stage of the valuation, as an add-on to the core analysis. Instead, they already try to capture the relevant, say, environmental factors at the time of assessing the company's strengths, weaknesses, in competitive position, basically fundamental analysis. Now, the forecasting and valuation, that's the element where we obviously establish a view over 5 or 10 years. We may want to do it we may wish to carry out discounted cash flow forecasts. So inevitably one sets out expectations for the future development of revenues or margins, or in the case of DCF models, projections of free cash flow or free cash flow to equity, running into perpetuity possibly, if we have a view on, say, perpetual growth rates or terminal growth rates. And ideally, ESG issues or ESG factors would have been incorporated into those projections, forecasts, and expectations as part of the analysis and forecasting process. Yes, there are still some entities who leave that until the very end. So having understood and the company having set forecasts for the next, say, 5-10 years, they then try to make adjustments to, say, the cash flow in 5 or 10 years from now, based on what they believe may happen when it comes to, the need to invest in particular technologies, or the possibility of paying fines for certain environmental valuations. But ideally, the analysis should be reflected in the forecasts themselves when we first project them, as opposed to leaving the ESG as a bit of an add-on to the whole process. And when it comes to the selection of valuation techniques, we sort of recognize that not all ESG factors are sort of quantifiable and easy to incorporate in, say, specific forecasts or views on future growth. And we recognize the fact that there are some issues, especially in the sort of ethics and kind of governance side of things, where we can't reflect our, say, concerns or risks in a specific future forecast. And so there is room, and this is what many people do, there is room to reflect such unquantifiable concerns in, say, the discount rate that is chosen by the analyst. So when we get asked what it is, at which stage to incorporate the relevant ESG factors, our message is that, in our view, the most advanced signatories try to incorporate the relevant ones at the start of the process when carrying out fundamental analysis. But of course, any, say, governance concerns can also be reflected in towards the end of that process when a particular discount rate is picked for the valuation model. Right. So those are the sort of the key messages I wanted to put across. On the following slide, actually, we can have a quick glance at the following slide. I mentioned some examples of the sort of things one could take into incorporation or into account at different stages of the analysis. I've touched on some of these. I don't think they require any sort of in-depth explanation. To those of you familiar with this space, they are self-explanatory. I would just like to move on to mention the passive space in a bit more detail. So I think we have slide 12, which shows those I would say quadrants, the stages or the processes in the passive equity space. And we recognize the fact that in the passive investing space, most of the activity that reflects ESG relates to the index design, either index designed by the index providers, or this can also be done by asset managers who sort of provide this service to their clients, where they take into consideration client requirements or wishes, and then they design a particular index or a benchmark for them based on a number of characteristics. The reason I'm mentioning this is because in the investing space, passive investing plays a very significant and probably increasing role. And we have observed lots of new sort of emerging ways in which ESG considerations can be reflected in the index design through the use of various types of data, both traditional as well as the more unstructured ones. We've seen lots of new techniques appearing, helping with sort of filtering the universe and making decision rules with regards to which companies to include, exclude, or how to tilt the weights away from the parent index. So if you've got questions about that sort of space, feel free to ask those. But I think it's fair to recognize that this is a space that has seen lots of sort of evolution, lots of change over the last few years. I'm not going to be going through the remaining slides in detail, but there are sort of links to our resources in the listed equity space, our technical guides, intro guides, as well as some of the more sort of thematic pieces of content that we have released. If any of you are interested in the most pressing issues, again, fire away, please. Ask those questions. I would be happy to highlight those for you. But in the interest of keeping to the timeline, I will end my short contribution at this point, and I'll be happy to answer any questions.
Thank you very much, Bartek. But if any one of you has any question, please, you can also raise your hand or feed in a question in the chat box below to ask Mr. Michael Bartek. I believe no question here, but if you later have any question, please feel free to drop questions in the chat box below. Okay, thank you very much, Mr. Michael Bartek, Senior Lead, Listed Equity Investment Practices, PRI, for a remarkable presentation. Thank you very much. And next, we'll be having a presentation on ESG integration in fixed income by Ms. Carmen Nuzo, Head of Fixed Income Investment Practices, PRI. May I kindly remind all participants that you're able to send in all the questions through an online platform, or else you're welcome to ask speaker at the end of this session too. And now, Ms. Nuzo, the floor is yours.
Thank you very much. Delighted to be here today, and thanks for the opportunity. I'm the head of fixed income at the PRI. I've been working at the PRI since 2017, where we've been gradually building upon the program. If I could have the next slide, please. So the idea for today is to just give you a brief overview of what we do within fixed income at the PRI, focus most of my presentation on what it means to incorporate ESG factors in credit risk, which is one of the primary risks that affects bond valuations. I will also address towards the end of the presentation a few markets misconceptions that are prevalent in this segment of the capital market, and then there will be, like before, an opportunity to ask questions at the end. Next slide, please. So in this chart, you see how the assets under management by our signatories are split. We count at the moment with over 5,000 signatories, most of whom are asset managers. There is an increasing share of asset owners as well, and a small share of service providers, such as data information providers related to ESG or even credit rating agencies. Collectively, they manage over 120 trillions in US dollars, and about 40% of that is invested in fixed income instrument. If you focus on the right-hand side of the chart, the right-hand side pie shows that the lion's share of this fixed income investment globally is in sovereign securities, and slightly more than a quarter is in corporate debt, and the rest is in other fixed income asset classes such as securitized debt or private debt. Next slide, please. This chart shows again the global asset share distribution, but also the one in Asia, excluding China and Japan. And if you focus on the pie in the bottom right-hand corner, you would see that actually the distribution of the fixed income instruments in Asia, excluding China and Japan, is slightly different from the global one. Insofar, the component of sovereign investment is still predominant, but there is also a larger share compared to the global asset allocation invested in corporate bonds, and the rest in other fixed income instruments. Next slide, please. So at the moment at the PRI, we have 5 work streams running. The ESG in Credit Risk and Ratings initiative that I will cover more in depth in a few minutes, but we also have a dedicated work stream focusing on sovereign debt investment, on sub-sovereign debt investment, on private debt, and also in securitized products. Next slide, please. So fixed income investors have approached responsible investment practices a bit later than equity investors, partly because the asset class is more complex. You have different issuers, as I've illustrated by the plurality of fixed income programs that we have. The instruments are different in terms of durations, structures, and also, the lack of voting rights has been perhaps an excuse for not getting involved until recently. But from 2015, we've seen really a pivotal moment in fixed income investment practices, partly propelled by the signing of the Paris Agreement, the launch of the SDGs, but also an increasing appreciation, I would say, of ESG factors as a risk to their investments. And being focused mostly on the downside risks, most of the fixed income investors that embrace responsible investment practices have a risk mitigation approach. So on the right-hand side of on the left-hand side of this chart, you see a two-dimensional approach. Most of the investors that apply responsible investment practices are trying to maximize returns while mitigating risks. But more recently, we've also seen them adding a third dimension, what we call real upward outcome achievements, which has been facilitated by the rapid growth that we've seen in the market of thematic bonds that are either by use of proceeds or because they're linked to specific key performance indicators that are trying to achieve a specific environmental or societal impact or outcome. Actually, I'd like to spend 1 minute on this word outcome because we're quite keen at the PRI to use the word outcome as opposed to impact, because impact is usually associated with a positive outcome, whereas we really stress that it's as important as producing a positive outcomes, also contributing to reducing negative outcomes. So we're not proponent of divestment unless it's really necessary, but really we want to work with issuers in trying to help them in a trajectory that is needed to put them on a more sustainable growth or business model path. Next slide, please. So when I said earlier that I wanted to focus mostly on ESG and credit risk, this is because of the various risk factors in bond valuations, and I've listed here a few: inflation, policy rate changes, credit risk, and liquidity. How ESG factors can affect credit risk is perhaps the area where it's been easier for investors to conceptualize how this could happen. There is now growing appreciation, particularly because of the high inflation that many countries are experiencing, of how ESG factors can also affect inflation dynamics and consequently monetary policy developments. But really from the very beginning, considering how reluctant fixed income investors were 10 years ago to embrace responsible investment practices, credit risk, i.e. the probability of default of an issuer, has been the area where it's been the easiest to conceptualize the impact of these ESG factors. Next slide, please. So at the PRI back in 2016, we launched an initiative called ESG and Credit Risk and Ratings Initiative with the purpose of making ESG factors more transparent and systematic in credit risk assessments. At the moment, we work with 182 investors and 28 credit rating agencies. The investors manage collectively more than $40 trillion, so it's one of the largest collaborative engagement that the PRI has organized so far. And we work with large global credit rating agencies such as Moody's, S&P, or Fitch, but also smaller credit rating agencies that are quite rooted either regionally or by product. We work with 2 in Japan, 3 in China, several in Latin America, and the number is growing. So the supporters of the initiative sign a statement, which is still open to new signatories. And with them, we've organized a string of roundtables connecting, in a first instance, between 2017 2019, credit analysts from investment firms with credit rating agencies. And since 2020, we've extended these roundtables also to borrowers, primarily corporate borrowers for now, but we're also beginning to engage sovereigns more directly. Next slide, please. So during these roundtables, we started discussing 4 main areas that we called initial disconnects, because we saw that really the credit analysts on the investor side and the credit rating agencies were not talking the same language, or there were different different ways to conceptualize some of these areas. So the first area was the materiality of ESG risks. What are the factors that are financially material, and how do they impact the balance sheet of an issuer? How do they affect the cash flow? How do they affect revenues? How do they affect the bottom line? How do they affect R&D expenditures, for example, if a company or a sovereign is embarking in a transition towards a low carbon economy. The second area that we discussed at length was the credit relevance of time horizons. This is because fixed income instruments, unlike equities, come with different durations, different bond terms. And so although even if they are more complex, they also offer more optionality, because, for example, one could consider buying a 2-year bond, knowing that the issuer would have an enough cash flow to repay that bond, but not necessarily a 10 or a 15-year bond. That could be more exposed to some ESG factors. And also one of the issues that we debated at length was how forward-looking should credit rating agencies be, given that they focus most of the credit rating assessments on a 3 to 5 year time horizon, whereas many of the ESG factors that are talking about go beyond that, that time period. Thirdly, we talked about the approach that needs to be built. Michael, my colleague alluded to this earlier. Should it be a built-in approach, like a truly integrated approach, or a bolt-on approach that looks first at the ESG profile of an issuer and then what is the credit impact of ESG factors on an issuer? And I'll cover this point a bit more in depth in a minute. And finally, on transparency and communication, we talked a lot about how to implement the communication between credit analysts and the credit rating agencies, but also within investment firms, how do we break silos between, say, the ESG team, for example, or the credit analyst team, or the equity teams versus the fixed income team. Next slide, please. So some of the issues that we also consider were when framing ESG factors in credit risk assessment, what type of factors these are. Are these event driven? Are these linked to a trend? Are these regulatory driven? And then we also discuss an important difference at the fixed income level. That is the factors have to be considered not only at the issuer level, but also at the single issue level. And finally, how do we consider these factors at the overall portfolio construction level? The breadth of the factors, are they macro related? Are they micro related? Are they sector related? And again, the timing really important. Are these factors present? Are they emerging, or are they just potential? In that case, how do we take these into account? Next slide, please. I will not go over in depth over each of these elements that I've just highlighted, but I encourage you to take a look at the publications that we've produced as part of the series, because there is much more that could be learned. The important thing that I wanted to focus on is in fixed income investment. What is really key is, one, to discern how visible these factors are. Secondly, to assess their probability. But once we've assessed their probability, we also have to think about how recurrent these factors are, and if the company has enough reserves. Say, for example, in case they have to pay a fine, how big that fine is. Is it a fine that is going to be recurrent, or is it one-off? So really what's important is trying to quantify what's the impact on the balance sheet, and has the company or the issuer, I should say, enough reserves to mitigate the risks related to these factors or not. Next slide, please. So here, in a very quick snapshot, I just wanted to flag the progress that the credit rating agencies that we've been working with have made since we've engaged with them over the last 5 years or so. There are three main areas of improvement on the analysis. You will see that there are many more credit risk credit rating opinions that are coming to the market with a clear outlining of whether ESG factors have contributed or not as main drivers of the credit rating opinion. This is also partly in response to changes in regulatory requirements that have happened in Europe. The credit rating agencies have upped their research in these topics. They publish now tons of documents on sector analysis or thematic analysis related to ESG. They also have a new sustainable finance department. They're training their analysts. They have web pages dedicated to ESG. They have explained more clearly how ESG factors feature in their methodologies, and this is also available on the website. And finally, they organize many more events, either with us or by themselves, related to ESG. Next slide, please. Very quickly, in the interest of time, I wanted to flag that we at the PRI compile a quarterly update of all the progress that credit rating agencies make. So I do encourage you to take a look at our website, because it's a document that contains a wealth of resources that could be used for either for your analysis or also for your credit risk assessments of a particular issuer. Next slide, please. turning very quickly to sovereign assessment, which is the other main area of focus for this audience today, I wanted to stress the fact that when it comes to sovereign credit risk assessment, many ESG factors that we now try to frame more explicitly, if you will, have traditionally been part of the sovereign debt analysis. This is also to an extent true for corporate debt assessment, but particularly so for the sovereign debt analysis, because many of the ESG factors that we focus on are linked to long-term trends that are they're usually embedded in the analysis of potential GDP growth and are very important for the assessment of the fiscal sustainability paths of several governments. I will not list all of these factors here. The slides will be shared after this presentation, so you can go through them more in detail. In this slide, you will find some examples of ESG factors that are relevant for sovereign debt analysis and also some useful sources. Some are traditional ones coming from national statistical offices or the World Bank or the IMF, for example, but there are also new resources coming to the fore, partly provided by ESG information providers, but also new business surveys that are important, or sovereign or country surveys that are important for sovereign debt assessment. So I encourage you to take a look at more in depth later this slide. Next slide, please. I mentioned earlier the growth of thematic bonds, green bonds, social bonds, SDG bonds, and more recently also the sustainability-linked bonds that are not use of proceeds bonds, but are more linked to the KPIs, the key performance indicators that an issuer decides to set as part of a sustainable strategy. As you can see from this chart, this is a market segment, which is particularly prolific in the sovereign debt market. We've seen a large growth in the last few years. It took a while to take off, but now it's very vibrant, and it's a useful way to focus both the issuer and the investor on specific environmental or societal outcomes, but we encourage investors to make it their due diligence analysis and really understand how the product is structured, analyze the reporting process that accompanies these products to make sure that the money is really allocated where the label says. Next slide, please. One area that is particularly challenging when it comes to sovereign debt analysis is the area of engagement. Engagement is particularly challenging also for any fixed income investors. More than challenging, I would say it comes less naturally, because not having voting rights or not participating in AGMs, it is less natural for fixed income investors to engage with issuers. Many of our signatories have traditionally done so, particularly with the corporate issuers, but with sovereign issuers, there are lots of barriers such as political sensitivities, fears of not having a big enough holding to have a voice, or maybe fears of having too big of a holding and not wanting the political attention or the media attention that sometimes accompanies this type of engagement. And also the shift to passive investment has discouraged this type of outreach to sovereigns. It's something that we are countering at the PRI. We're actually organizing a lot of roundtables now with sovereigns, starting with DMOs, with debt management offices, but we've also recently launched the first collaborative engagement with the Australian government, specifically on climate policies. So more to come on this space. It's something that we're trying to educate our investors to do more of, because we think that responsible investment is really is really part of responsible investment practices. Next slide, please. And then I conclude very quickly. I wanted to address 3 misconceptions in the markets. First of all, investing responsibly in fixed income doesn't mean buying green bonds. These are useful tools to implement sustainable investment strategies, but they're not the only ones. Mainstream bonds are equally important, and it's important to understand how ESG factors may affect the probability of default of issuers, but also work with the issuers to accompany them in the transition towards more sustainable business models in the case of the corporate issuers, or growth models in the case of sovereigns. Secondly, there is a huge confusion in the market between what it means to implement ESG factors, to consider ESG factors in credit ratings, that is the probability of default, and what are now known in the market as ESG ratings. These are profiles of issuers based on ESG credentials, but they're not necessarily linked to the financial materiality of ESG factors. So there is a clear distinction. There are two different tools that are useful for investors. They're complementary. Some of the underlying input to calculate them overlap, but they serve different purposes, and investors should be aware of this. And finally, that even if if you can go back to the previous slides, the last misconception is really related to the fact that sorry, now I've lost my train of thought, that bondholders should be engaging with their issuers, and this engagement is not only a practice reserved to shareholders. Next slide, please. So I just wanted to leave you with three key takeaways. One, it's true that ESG in fixed income is more complex than for equity investing, but it also offers more option, more flexibility. Secondly, that it's important to consider ESG factors not just at the issuer level, but also at the issue level. And finally, that engagement, as I said many times, is important, but it really depends, and it needs to be conducted depending on the issuer with several channels. So the last slide here just summarizes some useful, can you go to the next slide, please? Next slide, please. Yes, some useful website where you can find a lot of the resources that we've produced, reports, webinars, podcasts, and case studies. There at the top, you'll find the generic fixed income page. And then if you're interested in any particular asset class, there is one dedicated page per work stream that we're running. And at the end of the slide deck, you will also find, next slide, please, our contacts for with my email and the email of the rest of the team that is working with me on these issues. With that, I thank you, and I hand over back to Sinida. Thank you.
Thank you very much, Ms. Nusso, Head of Fixed Income Investment Practices from PRI, for the very fruitful presentation. Ladies and gentlemen, let's move on to the next session of a case study for applying ESG integration in equity asset. And this will be presented by Mr. William Ng, Senior ESG Engagement Analyst from Hsbc Asset Management. Once again, feel free to ask or feed in any questions in the chat box below. So Mr. Ng, the floor is yours.
Thank you very much, Sawadee Krab. Thank you to the SSC and colleagues at PRI for inviting me to speak on this webinar today. It's a great pleasure to be here and share our approach at Hsbc Asset Management to responsible investments and ESG integration. Maybe just to introduce myself, a little bit of context. So I am one of the senior ESG engagement analysts in the responsible investment team. I am based in Hong Kong. I work as part of the global stewardship team, but I also work very closely in Hong Kong with the active equity and active fixed income teams to support them with ESG integration, as well as engagement activities with our issuers and also our voting activities. I've been with Hsbc for about 3.5 years, but the ESG work and the responsible investment work at Hsbc predates me by many years. We're one of the early signatories of PRI. Next slide, please. So actually, it is quite encouraging to see that ESG has evolved a lot over the past few years, and particularly I think in Asia in the last 2 to 3 years, we're seeing a lot more expectations from asset owners, from asset managers on corporates, and also from the regulators on the entire ecosystem, whether it's corporate issuers, but also asset managers as well. So this is very encouraging and also great to see the disclosure requirements that the SEC in Thailand has put out for companies across issues such as climate change and human rights. Next slide, please. So very briefly, what do we mean by responsible investment? So at Hsbc Asset Management, when we talk about RI, responsible investments, it's really two sides of the same coin. It's really about providing risk-adjusted returns through the lens of understanding the sustainability issues, the ESG issues of a company that we are investing in, but also at the same time providing and looking at delivering positive real-world outcomes. And we believe that investors have a key role to play to incorporate these ESG considerations into the investment decision. And this includes the impact of the investments on the environment and communities and societies to generate excess returns, but also using our influence as stewards of capital to drive sustainable objectives and to deliver the other side of the coin, which is the real world outcomes. Next slide, please. I think my colleagues at PRI have also talked a lot about ESG integration, so I'll skip this one. Next slide, please. The different components of ESG integration at Hsbc comprise screening. I think we saw a lot. We saw Mikhail talking about that earlier. So screening, negative screening on things such as banned weapons. But also increasingly, the interest from clients is also to see screening on product categories such as fossil fuels, and depending on the product objective, what are other types of categories as well, including alcohol, gambling, and tobacco, and so on. And to actually do screening effectively and meaningfully, and a key aspect is ESG data. So I'll talk a little bit about that in a moment. But looking at various types of ESG data and how that can help us with our investment process. In addition, we of course have our own fundamental research, our deep research into the how ESG issues impacts the company, the enterprise value, through other sources, including sell-side research, but also research that we generate and analysis that we generate ourselves, through understanding the companies, through the many years potentially that we hold them, and also company disclosures. And it's great to see the level of disclosures in ESG across ESG issues at corporates that have increased over the last few years. Active ownership is a key part of ESG integration for us as well, and I'll touch on that towards the end. And it's actually goes very much hand in hand with our approach. And then just one final point on the previous slide is around risk management. So you'll see in the bottom right-hand corner, and I'll talk a little bit about that in a minute as well, using ESG data and using our research to understand where the key material risks are that will potentially have a huge impact on the company, whether it's reputationally or in terms of the fundamentals. And so that helps us how we prioritize the risk management. Next slide, please. I think first and foremost for us is how to actually apply and integrate ESG into the investment process. First and foremost, the key aspect is understanding the material issues. So we have worked over the years on a materiality framework that internally, and this serves as a guidance document for investment teams. And you can see an example of this. So we do this at the sector level. And we have different sector checklist for the 24 sectors that we have carved out internally to look at, well, what are the different E, S, and G issues for each of these sectors, and whether they are risks or opportunities for those sectors. And this serves as the starting point for us, for our investment analysts, for both equities and actually also fixed income asset classes. And from this, they can then apply and add on their knowledge of the company, of the market nuances, to develop a more in-depth research and analysis on these ESG issues of the company, and integrating these into their fundamental analysis and also valuation. So you can see here, this is a utilities example, and the typical issues you may see on E would be around greenhouse gas emissions, shift to the on the climate transition. On the S side, health and safety is a typical one. Community impact of your operations, but also governance issues such as ownership structure and related party transactions that we see a lot as well in Asia and actually other regions. Next slide, please. Here I want to highlight the materiality issues, and the material issues are not static. So two other concepts we also try to build into our materiality framework is double materiality and also dynamic materiality. So double materiality is recognizing that not only that the impact of ESG issues on the company on their enterprise value, but also they have an impact on the environment, on communities and stakeholders as well. And this is important because whilst some of these may be externalized and crystallized for the time being, a lot of these systemic issues will become material over sort of a different time horizon for the company, and so they can come back and become liabilities. So this is something that we also integrate and engage with companies on. On dynamic materiality, is really recognizing that companies' exposure and the ability to manage and the impact of the issue and the costs are constantly evolving. So you may have issues that are sort of in the in the time horizon that may not be material yet, or they're not regulated yet. So perhaps things like the social impacts of climate change, but increasingly there's more and more discussions around, the just transition and how that can impact the business value and the fundamentals. And then maybe on the human rights side, and all, that is also becoming more politicized, but also seeing more regulations around this as well. So recognizing how this will change over time is an important part. Next slide, please. And we do this. We keep up to date of the material issues through something called the Factual Sector Team, and this is where we have across the global locations, we have different sector analysts, as well as responsible investment RI specialists, ESG specialists such as myself and my colleagues, actually coming together to discuss the evolving issues, ESG issues of a particular sector, and that will become sort of a feedback loop to update us on the materiality framework that I showed you a few slides ago. Next slide, please. Another key aspect I mentioned earlier is on ESG data. So this is a key component of the integration process, and to measure the performance of a company against material issues is having data, raw data on particular data points, and also scores is important. Internally, we have a platform to that our investment analysts and teams can access the ESG scores, as well as the data and research for their use through the investment process. I think it's worth highlighting here that it is difficult to reduce all the complex issues into one single number or one single letter. And so when we look at ESG data and scores, we must also recognize and understand what the objective is, what the raw data and scores can and can't tell you. So what are the limitations, and also the underlying methodologies. But looking across the different data providers, you'll be able to see the different objectives that they can serve and purpose that they can serve. Okay, next slide, please. Just very quickly pulling it all together, so maybe a summary of what I've described so far. On the right-hand side, you'll see, on the left-hand side, you'll see the process and the data, and then going across to how these can form part of the fundamental analysis at the issuer level, but also looking at the more broader portfolio level, so looking at the analytics at the fund level as well, both for internal performance purposes, but also for external reporting. One thing also to mention here is the risk management piece in the middle. So the research and the data that we have allow us to identify the high risk companies using ESG ratings, but also UN Global Compact compliance levels to then determine which ones we really need to prioritize our enhanced due diligence on. Okay, next slide, please. I'll skip actually this one. I think there's a lot of detail here that please do take a look. One example I do want to maybe talk a little bit about this. Next slide, please. This is one of the global cosmetics company held in our active portfolio, equity portfolio in Asia. And maybe to highlight here, there's a combination of the different ways of how we integrate ESG, and maybe actually starting at the bottom, you can see we apply exclusions, and so this company actually feeds into one of the thematic funds that we own, that we run, and the themes are social, focuses on the Asian social megatrends. So some of the exclusions are aligned to that. So excluding certain companies on a category such as alcohol, gambling, tobacco, and weapons that I mentioned earlier, that would have very negative impacts on people and communities. UNGC compliance, as I mentioned earlier, but also on the outward-looking piece, having a UN SDG overlay to understand the impacts of the company on the various SDGs that are key to this fund. And through this process, through this analysis and research we do into this company, we also engage on a few of the key issues with management, including circular economy, net zero targets, as well as biodiversity and their governance structure. Okay, next slide, please. Just conscious of time, I'll briefly talk about the on the passive side. So I guess a key message here is that actually ESG data plays a really important role in the passive strategies. And over the past couple of years, we've been working, my colleagues have been working very hard on launching some sustainable ETFs. And a couple of examples here you can see. One is lower carbon indices, looking at and using ESG ratings, using carbon intensity reduction metrics and fossil fuel reserves to build these indices with our index providers. And then on the Paris-aligned indices, they also look at the climate's value at risk, companies that have decarbonization targets, as well as metrics such as green revenues and those that might provide green solutions. So on the passive side, actually the ESG data becomes even more important. But again, recognizing where the limitations may be and using engagement as a key tool for us to drive positive change and with the companies. Okay, very quickly, I will speak a little bit about stewardship. Maybe we can skip to slide 19, please. I'll stop on this slide, but maybe what I want to highlight here, and if we have more time at Q&A, we can discuss in further detail, but this sort of illustrates our approach to stewardship and engagement. And it's really threefold, and having these three key objectives in how we engage with companies. And one is to drive growth through having helping and supporting our companies to be more future ready and to push the boundaries to more sustainable opportunities. Secondly is around risk management, and I mentioned some examples in the slides earlier, and setting expectations that we have on companies to really manage these risks, both inside out and also outside in. And then finally, to push for transparency, so improving disclosures and improving transparency in the capital markets will help the entire, hopefully, the ecosystem on having better understanding of what the companies are doing and holding them to account. So I think I will pause here and look forward to more discussions in the Q&A session. Thank you very much, Kapun Krap.
Thank you very much, Mr. William Ong, Senior ESG Engagement Analyst at Hsbc Asset Management, for sharing your valuable experience. And let's now hear the experience from another PRI signatory, Mr. Eric Neach, Head of ESG Asia Manulife Investment Management, who shared a case study for applying ESG integration in fixed income. So if any of you have any question, both for Mr. Ong or the speaker, please feel free to drop in any questions. Mr. Neach, please.
Sawadee krap, and thank you so much. It's such a pleasure to be invited here by the PRI and the SEC, and also thanks to Will for that presentation. So I think I'll start with just a quick kind of introduction, an overview. So if we could go to the first slide. The Manulife Investment Management is the investment management arm of Manulife Financial, a global insurance and wealth company, and so I work in the investment management arm, which manages money on behalf of the insurance fund, but also many third-party clients. And so we have about 800 billion in assets under management, and a very large presence, particularly in Asia. So in Asia, we're in 10 different markets, and with both credit and equity portfolios that I work with across the region. So I lead the sustainable investing team, really looking at the ESG integration into those funds, as well as the new thematic funds that we're developing. So if I can take you to the next slide. What we're applying across most of our fixed income funds, and what we're really trying to apply to all of the investments that we manage, is ESG integration. And so what we're trying to do is take the environmental, social, and governance data and information that's become available and look at how that's affecting the companies that we're investing in. And so we see this usually materializing in two different ways, which are shown here. One is through shocks, which can be quite a kind of events that develop quite quickly, and maybe by definition harder to predict, things that can disrupt business or incur fines or accidents. And those are quite different, I think, than some of the long-term trends, some of the kind of secular themes around changes in the environment and society. So both are very important. The shocks tend to be maybe more related to risks, while the trends can be more related to both risks and opportunities. And so both, I would say, are very important for fixed income investment, but certainly the shocks can destroy fixed income value very quickly. And so we try to look at how those types of ESG exposures will impact companies' financials, and through that our investment. So if I take you to the next slide, the great thing is that we have tons and tons of information that's become available on this. So literally millions of data points through the different ESG data providers that we're able to subscribe to. The challenge is that there's millions of data points to sort through, and so we try to build analytics on top of this and filter it down into things that are really decision useful for our analysts and investment teams. So on the next slide, similar to what was mentioned earlier in terms of the Hsbc materiality mapping and the process that Will talked about, we try to focus on the most important and the most relevant topics. And so we've taken the Hsbc materiality maps and made some changes where we felt it was appropriate. And then we tried to take those a couple steps further. So we built a dynamic tool that in Bloomberg that the analysts are able to pull up a particular company, and then it will surface the materials that are most relevant, but it will also tell them whether it's likely to be an income statement issue, is it likely to affect the growth of revenue, or is it likely to be a cost issue where it might be impacting margins, or is it more of a balance sheet issue and it might be kind of creating a future liability or a cash flow issue that may impact future capex. And so they're able to kind of focus in on that information that's most relevant to that, and then look at how the company is performing relative to peers. And then lastly, it will also suggest questions that they could ask in a management meeting with the company. And so we do that for both our we're looking at the company performance, so it's relevant to both our equity and fixed income approach. But I'll go into a bit more detail on how we do it in our fixed income portfolios. So if I can take you to the next slide. So we try to develop the ESG process in practice that is appropriate for every investment team's market and investment style and approach. So what we require across all of our investment teams at the firm is that they are applying the ESG integration comprehensively. So we're looking at them to be able to show how they're using the data that's available and then incorporating that into the research and bringing that into the valuation and the security selection, and then through the ongoing investment monitoring, such as the risk management and some of the portfolio construction decisions, and then through the active ownership from engagement and all the way through the kind of end of the investment life cycle. But the way that that's done in practice can differ, according to what's most useful for the team that's applying these approaches. So this shows one of those, which is more for our fixed income teams in North America, where the market is more driven by spreads, and so they look at the E, S, and G performance of the companies that they're assessing, but then they try to think about how that would impact the fair value of the spreads. On the next slide, you can see kind of how this works in practice, where they'll look at the relevant E, S, and G issues, and on top of the their kind of existing analysis, make adjustments to their fair value assessments. And so in this case, the bar on the left means that at a first glance at the financials alone, it might look like an attractive credit relative to where the market is pricing it, which is shown in blue, unattractive. It's got a tighter spread and a higher valuation. But after looking at the risk that they would need to be compensated for the different ESG issues, they decide to increase that fair value spread, and they would need to see the market widen in order for that investment to be considered attractive. So that's kind of the approach that's taken in North America, and that's a bit different than what we're doing in Asia. So if I can take you to the next slide. In Asia, the market is more driven by credit ratings, and so we have an internal credit rating approach where we look at we assign a a credit rating to every company, but we also assign the ESG performance and exposure of that company, and we will adjust our internal credit ratings on the basis of those assessments. So we will move our internal ratings up or down, and then when we look at how we view the credit risk versus how the market is pricing the credit risk, that will be incorporated into our credit assessment. So in addition to looking at the risks, we also want to flag the companies that are managing their performance quite well and exposed to opportunities. And so we also try to flag companies that we consider to be best in class in their industry peer group, so that the portfolio managers can apply an overweight to those. So on the next slide, and sorry, I should have said that everything that I was talking about was so far has really been in relation to our corporate credit analysis, but we've also developed a kind of an approach to sovereign fixed income investment. So through some work with the UN, through a working group under the UNEPFI, we looked at ESG integration into sovereign fixed income and developed a model and a methodology that looks at ESG metrics that are available at a country level. And then we have scored nearly 200 countries and jurisdictions on those metrics, and then broken them up into categories based on the level of development. So we have 4 categories from advanced through countries that are at earlier stages of development, economic development, so that we get a like-for-like comparison. And then those are scored and aggregated together within those groups, so that we get an assessment that's comparable globally. And so what's important about this model is we've done it only for ESG issues and performance. So it's really meant to be used in combination with our sovereign financial models. And so it creates an underlying indicator, but then it also has a momentum factor, so we can see kind of the level of improvement or deterioration, and we're able to through that have both a short-term indicator and a long-term indicator, so that we can match this with the tenor of the investment that Carmen mentioned. And so similarly to our corporate process, this leads to an adjustment of our internal credit ratings that could be both positive or negative. So on the next slide, in addition to the integration into corporate fixed income and sovereign fixed income, we also believe that engagement and active ownership are very important for fixed income. So engagement is something that's often associated with equity investment, but we think it's especially or perfectly applicable to fixed income investing also. I think even in Asia, many times where there are family-owned companies or state-owned companies, different types of structures that may have public debt but not public equity, I think fixed income engagement can be very important and very pertinent, and we often find that companies are receptive to having engagement discussions. I think also it's often the case that fixed income represents a much larger portion of the capital structure than the equity does. And so in many of these cases, which are especially true in Asia, I think engagement can be quite important. So on the last slide, I'll show just a couple of the methodologies that we apply and some of the ways that we think about going beyond ESG integration. So ESG integration, we believe, is appropriate for all of our portfolios, but we also have clients that are looking for different sustainable investing solutions. And so when we're developing a fund with an explicit sustainable investing objective, we can apply some other methodologies beyond ESG integration. So ESG integration would still be the foundation, that would still be the kind of the core that we're building upon, but then we might apply negative screening or a kind of an exclusionary approach where we think it's appropriate to remove companies that could be doing harm to those sustainable investing objectives. However, we want to really make sure that we're investing into the solutions that will be solving some of the sustainability challenges that we're facing. And so we'll also look at different best-in-class screens and positive screening to identify those companies. We don't necessarily think that a sustainable fixed income fund has to be a green bond fund or a social bond fund, but we do often use those labeled instruments, if they're credible, as a tool for helping to achieve impact in those portfolios. And then sometimes we'll look at themes and different metrics that we can measure to make sure that the portfolio as a whole is having a positive impact and delivering on the objectives that it intends to. Similarly, as we mentioned, engagement would be a key part of these strategies. So let me pause there and thank you again, and hand it back to open up for questions.
Thank you very much, Mr. Need. If you have any question, please raise your hand or feel free to drop in the chat box below. James, it's very hard for me to see the questions here. I'm not sure if there are any question. Maybe you can ask on my behalf.
Sure, of course. So we've got some questions that have come in both for Eric, but for our other speakers. So great if we can have all of our panelists joining us on camera. Thank you so much. And I know we're running a little bit behind, but we'll try and get through everyone's questions that have come in and not keep anyone too late from other commitments. So I'm going to start off with you, Carmen. One question that I know you get a lot, so you're used to responding to this one. The question was, should we start with ESG credit rating or ESG ratings? So this comes back to one of those misperceptions or how to think about and how to talk about this in the fixed income space. Over to you.
Yeah, great. Thank you, James, for asking the question, because I didn't have enough time to cover it during the presentation, and I'm glad you raised this issue again, which is an important issue, because for fixed income investors, the moment you mention rating, immediately the notion of credit rating comes to mind, whereas the ESG rating is a newer concept, if you will. And I'm actually taking the cue from Eric's comments. He said earlier that they have an ESG profile of the issuers that they invest in, and then based on that ESG profile, which measures really, I suppose, the performance of that issuer based on the ES and the G, then they calculate the credit impact of those ESG factors on the probability of default of an issuer. So as I said earlier, credit risk measures the probability of default. The ESG ratings is a profiling of an issuer based on ESG credentials. So some of the inputs that are needed to calculate these two tools are the same, but the focus is different. So the credit rating is really focused more on the financial materiality of ESG factors and how these impact the balance sheet, and in particular the cash flow, which is at the end what allows the issuer to repay its debt, whereas the ESG profiling may serve other purposes, for example, assessing whether the company is in the green sector, in the brown sector, and using those indications more for investing with an outcome. I don't know if that was clear, but I think part of the confusion also stems from the fact that many credit rating agencies have recently bought ESG information providers that produce these ESG scores, as I like to call them, not to confuse them with ESG ratings. But the regulator is looking into this because there is definitely a lot of confusion, and investors need to know what they buy and how these products are calculated.
Absolutely. Thank you, Carmen. Now, one question that I think everyone can jump in on, but primarily for Eric and for William. So 2 questions I'm going to lump here together. So the first one, as listed companies traditionally communicate their ESG information through narrative and comprehensive reports, do you have any suggestions for investors to quantify those informative data points to be meaningful for investment decisions? So really asking, how you as investors really draw out the key insights from what's disclosed to you. And the similar question coming from the other side. So referencing Will's presentation and the third-party rating agencies that you draw from, obviously there are a number of rating agencies. So as a listed company, it does take a lot of time and resources to complete and respond to each of those assessments. Is there any ESG rating agency which dominates, or which agency should companies prioritize if they are limited in time and resourcing in responding to the multiple outreach they may get and data requests that come through? So I'm not sure who'd like to jump in on that one first, but I think two sides of the same coin really here.
Thanks, James. Maybe I can take a first stab at this and then pass over to Eric. So I think that's a very interesting question. I think both I agree with you, are very much related. I was actually at an event last week in Hong Kong, first in-person event in a few years after COVID, and I was speaking to some of my peers who are currently in the consulting space, but also in the corporate sustainability teams. And I think the disclosure fatigue is real. I think a lot of companies do have increasing challenge to navigate what is which framework to use, what standard to use, and which ESG rating provider to engage with and disclose against, and so on and so forth. So there's a whole lot of data and disclosures and expectations around this in the ecosystem. I would say focus on the for companies, and when we assess companies' ESG credentials and the material issues, it really comes back to what they disclose rather than which sort of forum or channel they disclose it. And I think it's the quality of the disclosures that's really important. Are they identifying the material issues and the salient issues? So going back to the point around outward in and inward outward in and inward out issues, double materiality. So can they provide sufficient details around the disclosures and to demonstrate their performance and their progress in these issues to help essentially investors such as Eric and I and our colleagues to make informed decisions and make investment decisions in a meaningful way. So I think that is one key point I would come back to. And maybe Eric can add further insights as well. Thank you.
Yeah, no, thanks, Will, and I agree. I think I think it can be very challenging and exhausting. I mean, I think I can sympathize with that corporate view, because frankly, I think for us as investors, it can be quite challenging to look at all of these different frameworks as well. I think there is good news on that front, which is, it is recognized as an issue, and there is work that's going on to try and harmonize some of this. Largely, I would say in terms of the disclosure frameworks, there's Hsbc and GRI as two of the main ones. GRI maybe having more uptake in this part of the world, and then there's others like CDP and the Dow Jones Sustainability Indices and a wide variety of other disclosure frameworks. And a lot of those are trying to be at least wrapped up into the ISSB, which the International Sustainability Standards Board, which is hoping to try to bring some of this together. So, I don't think there's necessarily a solution today, but I would, share some encouragement that if you're disclosing in some of those, then hopefully that will be relevant for where the direction that everything's heading. I think for investors, taking that information and trying to quantify it, it quickly gets complicated, because I think if you take all of the potential environmental topics, climate, wastewater, biodiversity, mix them with social topics, as well as governance issues, the more that you try to consolidate all of these things into one quantified metric, the more that gets lost in the noise. So we find oftentimes that you're consolidating positive and negatives and things that aren't necessarily related to each other, and you're kind of losing the actually like the useful signaling value of the metric that you're trying to create. And so, and I think that's also true with the double materiality that Will mentioned, and both historical reporting versus kind of forward-looking thinking. So there's all these complicating factors, and I think wherever it's possible, it's just helpful to think about what is the objective of the investment approach, and then how can you maybe break those down into different pieces that can be quantified in a way that's going to help you meet those objectives.
Great, thank you both. Now, just very wary of time, we've got 2 or 3 more questions I hope we can get through. I'll ask everyone to try and keep your responses quite succinct. So coming back to Carmen and Eric, you may want to jump in on this. So we had a few questions, which was really around the engagement aspect that we briefly touched on, and one was around essentially, Carmen, a comment you'd made around the difference in how bondholders are engaging with issuers, obviously. And the differences, say, when you're a listed equity investor, and likewise, Eric, for yourself, it was a question around clarifying collaboration when it comes to engagement on the fixed income side. So maybe, Carmen, I'll let you just jump in first, and then Eric, you might want to talk a little bit around how Manulife has been undertaking collaborative engagement more broadly, but in the fixed income space as well.
Yeah, thank you. I'll be quick. First of all, not having voting rights doesn't mean that you can't engage. There are several channels through which you can engage, as William also suggested. You reach out to different people, not necessarily the investor relations. It could be the treasury departments, the CFO, etc. Secondly, the engagement has to be strategic. It's not just to ask more information or data, although even that in itself can be useful to identify blind spots. But it has to be strategic with a goal, with a specific goal, to influence, or at the very least, at least in the case of sovereigns, to convey expectations and how these are changing. And the timing may vary as well. For example, if you're a private debt investor, you can be much more impactful at the beginning of the deal and not later on. If you are investing in the secondary market, you could perhaps invest at issuance, but also afterwards during the ongoing investment process, process or at redemption point at time, which can be quite impactful. And also when one engages has also to think about what would happen in case the engagement is not successful. Do you have an escalation process and something in mind to take as a consequence of an unsuccessful engagement? So lots to think about, but do talk to companies, do talk to sovereigns. They actually value your information and your input, and sometimes it helps them as well to understand why they should be focusing more on certain E, S, or G aspects. Thank you.
I think those are great points about the timing of fixed income engagement prior to a new deal or a refinancing. And so I have nothing to add on that. I just completely agree. I think I think also in terms of the nature of engagement, most often the way that we started an engagement is looking to have a constructive conversation with companies. This is the best practices that we're seeing in the market. These are things that we're seeing maybe in another part of the world that might be helpful to you. And more often than not, we find that companies are willing to have those conversations. It doesn't, there's hardly ever questions around whether we have voting rights or, it's usually they're willing to take those meetings. And so James, to your point, sometimes we do this directly. Sometimes we do this collaboratively with other investors. Will and I have worked on collaborative engagement together. And so we'll do that usually through industry organizations. So the Asia Investor Group on Climate Change is one. In Asia, there's the Asian Corporate Governance Association. An organization called Asia Research and Engagement is another one. And then, of course, the PRI provides an incredible platform of different collaborative engagement initiatives and really a platform to bring investors together to have these kinds of conversations. So I think that can be very valuable, both for investors as well as companies. Oftentimes we hear, thank you for getting to a number of investors together so that we have a clear kind of unified message rather than many different investors kind of asking us different things, which can be confusing. So I think it's mutually beneficial sometimes.
Great, thank you both for those responses. And I think engagement or active ownership more broadly is a topic that the PRI and SEC and the UN should hopefully be able to return to in future capacity building sessions. Now we have one last question from the audience I want to raise, and this one is an interesting one. Keeping an answer succinct on this one might be a bit tricky, and I'll put it out there, whoever wants to jump in. So they have highlighted that recently there's a specific fund, which is in the US, which is established as an anti-ESG fund. There have been letters sent to big companies regarding their approach to managing ESG issues, and essentially some form of pushback in the United States against responsible investing. And so essentially just very open, what do you make of this trend? Well, I know we've talked about this in private before, but if anyone would like to contribute to this one, please do unmute yourself. I know we all want to be quite politically sensitive when we comment on anything of this nature.
It's a tricky one, isn't it? Look, I don't really know exactly how that fund is run or what investment process it uses. What I would say is that no matter what your investment strategy, there may be a period of time when it's going to do well and outperform everything else. Yeah, possibly for days, weeks, months, anything is possible. However, and just to be brief, it's increasingly clear to me, based on my conversations with hundreds of signatories or dozens of signatories, that taking into account environmental, social, and governance factors should really be in investment decision making, should be pretty much the standard way of doing things. It's not, it's just it's good practice to take account of the relevant factors, financial, ESG, whatever, that may impact the stocks or fixed income instruments valuation and hence price. So to me, it looks unreasonable to intentionally ignore what may be relevant for risk-adjusted returns. And whilst we may have all sorts of debates about who should be spearheading the issue of tackling climate change, should it be the government, should it be other organizations, should it be the financial markets, we can have debates about all that. We can have debates about the extent to which double materiality maybe matters more than the financial materiality. That's out there for us to discuss over many hours and days, whatever. But to intentionally ignore or disregard what may be material to an issuer seems a very strange way of going on about carrying out investment decisions.
Thank you, Michael. I'm not sure if anyone else would like to jump in here. I know we are very already 10 minutes over time, but I just echo, I think, your reasoning there, Michael. But the PRI and the commitment our signatories make is based on a belief that ESG issues can be material for investors, and thus you should look to understand them, analyze them, and incorporate that into investment decision making. And so it would seem contradictory or counterintuitive to restrict investors from considering an issue which, as you say, Michael, could be material. With that, we will leave it there. I'd like to, of course, thank all of our speakers again, and all of our audience. And with that, hand over to Sunita just to give our closing remarks.
Thank you very much. Thank you very much, honorable speakers, Mr. Bartek, Ms. Nussel, Mr. Nietzsche, Mr. Ng, and the moderator, James, for such an insightful session on responsible investment in practice, implementing ESG incorporation in listed equity and fixed income. And that's a wrap for today. Thank you very much. And we would like you to please scan the QR code with a phone to take a survey on today's activities. Today will allow us to better understand the concept of ESG